Example 9, illustration of depreciating components of an asset. Cut Etup company, a hypothetical company, purchases a milling machine, a type of machine used for shaping metal, at a total cost of 10,000. 2,000 was estimated to represent the cost of rotating cutter. So rotating cutter was 2,000, and out of total 10,000, 2,000 represented rotating cutter. Hence, the mill machine in itself is of 8,000. So 8,000 plus 2,000 equals to 10,000. The company expects the machine to have a useful life of 8 years and a residual value of 3,000, and that the rotating cutter will need to be replaced every 2 years. Assume the entire residual value is attributable to the milling machine itself. So the entire residual value is for the milling machine. And assume the company uses straight line depreciation for all assets. Now the first question is, how much depreciation expense would the company report in year 1 if it uses the component method of depreciation? And how much depreciation expense would the company report in year 1 if it does not use the component method? So in component method, we were going to depreciate both components separately. So 2000 would be divided by 2 because it's a straight line, there is no residual value. And 8,000 would be subtracted by 3,000 because the residual value is 3,000 and the life of this machine is 8 years. So 5,000 divided by 8 and 2,000 divided by 2 gives us 625 over here and 1,000 over here. So the depreciation in first year would be 625 and 1,000. So the total depreciation would be 1625. This is for component method, and for if it does not use the component method, so component method is not used, so it's quite simple that the total machinery is of 10,000 minus 3,000, that is your residual value, whole divided by 8 because this is the life of the mill. 7,000 divided by 8 would be 875. So for component method, $1625 is your depreciation, and for not component method, it's 875. Now the second question is, assuming a new cutter was with an estimated 2-year life, useful life, is purchased at the end of year 2 for $2,000. What depreciation expense would the company report in year 3 if it uses component method and if it does not use the component method? So if it is using component method, the mill component comprises of 625 and the cutter comprises of 1,000. And we want to find out in year 3 what would be the depreciation. So 625 over here, 1,000 over here. Now after second year, the first cutter is finished and we need to buy a new cutter, and the new cutter is for 2,000. So this 625 continues for the mill. The new machinery is for $2,000 and it would again be divided by 2 because its useful life is 2 years. So again the depreciation would be 1,000. 625,000 would again give us $1625 as your depreciation. This is for component. And we also want to find out if we are not using the component method. So if you are not using the component method, when we were not using the component method, each year depreciation was 875. Now at the end of second year, we again buy a new cutter for 2,000 and we divide this by 2 because the useful life is 2 years and the depreciation again would be 1,000. So at the end of third year, we were going to add 1,000. So your total depreciation when we are not using the component method would be 1875. So 1875 when we are not using the component method, and the depreciation will remain the same if we are using component method. Assuming replacement of the cutter every 2 years at a price of 2,000, what is the total depreciation expense over the 8 years if the company uses the component method, compared with the total depreciation expense if the company does not use the component method? So if we are using the component method, we realized that each year the depreciation would be 1625. Even after second year, our depreciation came 1625, and this would going to continue. and we were going to buy total of 3 new rotators, because in 8 years this first one is initially in the mill, and we need to buy additional 3 more cutters. So each year the depreciation would be 1625. So 1625 multiplied by 8 would going to give us 13,000. This is for component method. If you are not using the component method, we realize that each year the depreciation was 875, and at the end of second year we were adding 1000 each year. So this is 1 year, 2 year, 3 year, 4, 5, 6, 7, 8. So we were going to buy the new cutter 3 times. So each year $1,000 would be added. So 875 multiplied by 8 plus this 1000 will going to come 6 times. So 875 into 8 is 7000, plus 6000 will going to give us again 13,000. This 13,000 remains the same. And if you look closely, the total machinery cost was 10,000 initially, and we bought 3 new rotators for $2,000, and the residual value was 3,000. So 10,000 plus 6,000 minus 3,000 would again is going to give us $13,000. How many different items must the company estimate in the first year to compute depreciation expense for the milling machine if it uses the component method? How does this compare with what would be required if it does not use the component method? So as we have just seen in the component method, there is this mill and the rotator cutter. So we need the value of the mill, that was 8,000, and the value of the rotating cutter was 2,000. We need to know the residual value of the mill, and we also know the number of years for the mill. So useful life of machine we need to know when we are using component method. The residual value of milling machine, that is also what we need to know. The portion of machine cost attributable to cutter, and again this is what we need to know. Portion of residual value of attributable cutter, over here it was 0, but still we need to know this. And useful life of cutter as well. So this was our useful life of cutter. So we need all these 5 elements. And now when we were not using any component, so component was not involved, so the value was 10,000 minus 3,000 whole divided by 8, that is your life of the mill. So do we need the useful life of milling machine? Yes, we need that. Residual value of milling machine? Yes, indeed, we need that. Portion of machine cost attributable to cutter? No, we don't need that, because we are using the total value of 10,000. Portion of residual value attributable to cutter, this again we don't know, and we don't need this. And useful life of cutter of 2, again we don't need to use this 2 in this when we are finding depreciation through not the component method. So we need only the residual value of the mill and the useful life of the mill, and also the total value of the whole machinery. Example 10. IAS 38 intangible assets provide illustrative examples regarding the accounting for intangible assets, including the following. A direct mail marketing company acquires a customer list and expects that it will be able to derive benefits from the information on the list for at least 1 year, but no more than 3 years. So here we are talking about definite lives. The customer list would be amortized over management best estimate of its useful life, say 18 months. Although the direct mail marketing company may intend to add customer names and other information to the list in the future, the expected benefits of the acquired customer list relate only to the customers on the list at the date it was acquired. Now in this example, in what ways would management decision and estimate affect the company's final statements? Now, the method we use, either straight line or double declining, would going to impact the depreciation, but it will not going to impact the total amount of depreciation accumulated throughout the time frame. And useful life will also impact. Useful life will impact the amount of depreciation. Either if the useful life is long, then depreciation amount would be less. If it is short life, then the depreciation amount will be more. But we need to understand that the total depreciation will not change. Again, let's read the solution. Because the acquired customer list is expected to generate future economic benefit for a period greater than 1 year, the cost of the list should be capitalized and not expensed. First point. The acquired customer list is determined to have an indefinite life, extremely important. Hence, it must be amortized. If it was definite, we would not amortize but test for impairment. Management must estimate the useful life of the customer list and must select an amortization method. In this example, the list appears to have no residual value. Both the amortization method and the estimated useful life affect the amount of the amortization expense in each period. A shorter estimated useful life compared with longer estimated useful life results in a higher amortization expense, as we have just mentioned over here. But the total accumulated amortization expense, now amortization and depreciation we are using interchangeably. Expense over the life of the intangible asset is unaffected by the estimate of useful life. So either we take long, if we take useful life as long or short, the total accumulated amortization will not change. Similarly, the total accumulated amortization expense over the life of the intangible asset is unaffected by the choice of method used. Either you use straight line or double declining, the total accumulated amortization will not change. The amortization expense per period depends on the amortization method, either straight line or double declining. If the straight line method is used, the amortization expense is the same for each year of useful life. If accelerated method is used, the amortization expense will be higher in earlier years and lower in the years followed by. Example 11. Revaluation resulting in an increase in carrying amount followed by subsequent revaluation resulting in decrease in carrying amount. Up first, a hypothetical manufacturing company has elected to use the revaluation model, very important, for its machinery. Assume for simplicity that the company owns a single machine which it purchased for 10,000. So the machine was purchased at 10,000 on the first day of its fiscal period, and that the measurement date occurs simultaneously with the company's fiscal period end. At the end of the first fiscal period after acquisition, assume the fair value of the machine is determined to be 11,000. So from 10,000 it goes up to 11,000. How will the company's financial statement reflect the asset? So if we initially go from 10,000 to 11,000, the difference of $10,000 will go to equity, and specifically it will go to other comprehensive income. So it will go to other comprehensive income in the equity part in revaluation surplus account. So at the end of the first fiscal period, the company's balance sheet will show the asset at value of 11,000. The 1,000 increase in the value of the asset will appear in the other comprehensive income. So other comprehensive income, and be accumulated in equity under the heading of revaluation surplus. So this 1,000 will go to revaluation surplus as part of other comprehensive income. At the end of the second fiscal period after acquisition, assume the fair value of the machine is determined to be 7,500. How will the company's financial statement reflect the asset? So initially we were 10,000, we went up to 11,000, now we are down to 7,500. The first step we need to make is that initially our revaluation surplus was 1,000. So we need to first eliminate this, and we need to have this loss of 2,500 reported in income statement. So at the end of the second fiscal period, the company balance sheet will show the asset at 7,500. The total decrease in the carrying amount of the asset is 3,500. So the total value is 3,500. 1,000 plus 2,500 is your 3,000. Out of 3,500 decrease, the first 1,000 will reduce the amount previously accumulated in equity under the heading of revaluation surplus. So this revaluation surplus will go down by 1,000. The other 2,500 will be shown as a loss on the income statement. So out of this 3,500, 1,000 will be reduced from revaluation surplus and 2,500 will be reduced from income statement. Example 12. revaluation resulting in decrease in asset carrying amount followed by subsequent revaluation resulting in an increase in assets carrying amount. So down first, hypothetical company, manufacturing company has elected to use a revaluation model, very important for its machinery. Assume for simplicity that the company owns a single machine which is purchased for 10,000. So the initial value is 10,000 on the first day of its fiscal period, and that the measurement date occurs simultaneously with the company's fiscal period end. At the end of the first fiscal period after acquisition, assume the fair value of the machinery is determined to be 7,500. So immediately the value goes down to 7,500 and there is a loss of 2,500. This would be reported in income statement. So at the end of the first fiscal period, the company's balance sheet will show the asset value of 7,500, rightly so. And the decrease of 2,500 in the value of the asset will appear as a loss on the company's income statement. Part 2. At the end of the second fiscal period after acquisition, assume the fair value of the machine is determined to be 11,000. How will the company's financial statement reflect the asset? So initially we were 10,000, we went down to 7,500, and now we are up again at 11,000. So the initial loss of 1,000 needs to be reversed. So we will going to report a gain of 1,000, and this is actually not 1,000, this is 2,500. So the initial loss of 2,500 would be reversed and we will going to have a gain, and this further increase of 1,000 will go to revaluation surplus and equity. So at the end of the second fiscal period, the company's balance sheet will show the asset value at 11,000. The total increase in the carrying amount of the asset is an increase in 3,500. So there's a total increase in 3,500. Out of which 2,500 would be used to reverse initial loss and 1,000 will go in our other comprehensive income or revaluation surplus. So of the 3,500 increase, the first 2,500 reverse a previously reported loss and will be reported as a gain on the income statement. So over here there is a gain in income statement. The other 1,000 will bypass profit or loss and be reported as other comprehensive income and be accumulated in equity under the heading of revaluation surplus. Example 13, impairment of property, plant and equipment. Sussex, a hypothetical manufacturing company in United Kingdom, has a machine it used to produce a single product. The demand for the product has declined substantially since the introduction of a competing product. The company has assembled the following information with respect to the machine. Under IFRS, what would the company report for the machine? So initially the carrying amount is 18,000. So we need to compare 18,000 with higher of the two. Now, higher of the two between present value of expected future cash flow and your value in use. So value in use is fair value minus cost to sell. So fair value minus cost to sell would be 15,000. This is your value in use. And present value of expected future cash flow is 16,000. So we need to choose higher of the two. So higher of the two is 16,000. And now we need to compare 16,000 with carrying amount of 18,000. So our carrying amount is higher and the value that we need to compare is with 16,000 and 16,000 is less. So it means that there is an impairment of 2,000 that will be reported in as a loss in your income statement. So under IFRS, a company would compare the carrying amount with the higher of its fair value less cost to sell and its value in use. We will start this example again. Example 13, impairment of property, plant and equipment. Sussex, a hypothetical manufacturing company in the United Kingdom, has a machine it used to produce a single product. The demand for the product has declined substantially since the introduction of a competing product. The company has assembled the following information with respect to the machine. Now under IFRS, what would the company report for the machine? So we are given the carrying amount. Now first of all, when we are using IFRS, we need to find out higher of the two between value in use, that is your present value of expected future cash flow, and your fair value minus cost to sell. We need to calculate fair value minus cost to sell. That would be 17,000 minus 2,000, that would be 15,000. So higher of the two is 16,000. So we need to find out higher of the two between value in use and fair value minus cost to sell. So the higher amount is 16,000. And we need to compare it with the carrying amount of 18,000. So 18,000 is more than 16,000. Hence there is this impairment of 2,000 that will be shown as loss in income statement. So under IFRS, the company would compare the carrying amount of 18,000 with the higher of its fair value less cost to sell and its value in use. The carrying amount exceeds the value in use, the higher of the two amount, by 2,000. The machine would be written down to the recoverable amount of 16,000. Yes, indeed, from 18,000, it will come down to 16,000. And a loss of 2,000 will be reported in the income statement. The carrying amount of the machine is now 16,000. A new depreciation schedule based on the carrying amount of 16,000 would be developed. So we need to come up with a new depreciation schedule as well. Now under US GAAP, what would the company report for the machine? So if we are using US GAAP, we first compare carrying amount with undiscounted expected future cash flow. So over here, our carrying amount is less than undiscounted expected future cash flow. So 18,000 is less than 19,000. So again, there is this amount that we can recover. Hence, there is no impairment. There is no impairment over here because the carrying amount is lower than undiscounted expected future cash flows. So under US GAAP, the carrying amount of 18,000 is compared with the undiscounted expected future cash flow of 19,000. The carrying amount is less than the undiscounted expected future cash flow. So the carrying amount is considered recoverable. The machine would be carried at 18,000 and no loss would be reported. Now let's suppose if 18,000 was more than undiscounted expected future cash flows. So if it is more, then impairment would take place and we need to go from carrying amount to fair value. Example 14, impairment of property, plant and equipment. Essex, a hypothetical manufacturing company, has a machine it uses to produce a single product. The demand of the product has declined substantially since the introduction of a competing product. The company has assembled the following information with respect to the machine. So 18,000 is your carrying amount. Present value of expected future cash flows or value in use is 14,000. Fair value minus cost to sell is 8,000. Now under IFRS, what would the company report for the machine? So we will need to choose higher of the two. So the higher of the two is 14,000 and 18,000 is your carrying amount that is higher. So we need to bring it down to 14,000. So the carrying amount exceeds the value in use, the higher of the two amount, or by 4,000. The machine would be written down to a recoverable amount of 14,000 and a loss of 4,000. There is a loss of 4,000 that is reported in income statement. The carrying amount of the machine now is 14,000 and a new depreciation schedule based on carrying amount of 14,000 would be developed. Under US GAAP, what would the company report for the machine? So under US GAAP, we compare carrying value or carrying amount with undiscounted expected future cash flow. So over here, undiscounted expected future cash flow is lower. So 18,000 is higher than 16,000. So it means that impairment will take place. There will be impairment that will take place and we will go from 18,000 to your fair value, that is 8,000. So there is a loss of 8,000 that will going to take place. From 18,000 will go to fair value, that is your 10,000. There is a loss of 8,000 that will be reported in income statement. So under US GAAP, the carrying amount of 18,000 is compared with the undiscounted expected future cash flow 16,000. The carrying amount exceeds the undiscounted expected future cash flow, so the carrying amount is considered not recoverable. The machine would be written down to the fair value of 10,000 and a loss of 8,000 would be reported in the income statement. The carrying amount of the machine is now 10,000 and again a new depreciation schedule must be made according to the new carrying amount of 10,000. Example 15, calculation of gain or loss on the sale of long-lived assets. So Mosilowski Dinners & Company, a hypothetical company, as a result of revamping its menus to focus on healthier food items, sells 450 used pizza ovens and reports a gain of 1.2 million. So there's a gain of 1.2 million. The oven had a carrying amount of 1.9 million. So the carrying amount is 1.9 million. There is also your book value. At what price did the Mosiloki sells the oven? Now the carrying amount is 1.9 million. This is your book value. And we made a gain of 1.2 million. So it means we must have sold, or the cash that we would have received would be $3.1 million. Because if we would have received $3.1 million, the book value is 1.9, we received 3.1. So there's a gain of 1.2. Hence option B is correct.